Okay, we are live back on Facebook and the Zoom meeting as well. So happy to have two of our friends here in today, Allyson Baumeister, who was a two-time chair of the Fort Worth Chamber. So thank you for your leadership. And Corey Holthouse, also with CLA, here to talk a little bit about the loan forgiveness of the PPP program. So we know there's been a lot of conversation around that and what does that mean. So wanted to bring them on just to answer some questions for you. So with that, I will turn it over to Corey and Allyson to take it away.
Thank you very much, Chris. Really appreciate it. We're very excited to be here today. And when we scheduled this, when Chris and I scheduled this, we did it on purpose today, thinking that we would have additional guidance from Treasury and the SBA on the PPP loan forgiveness, because the law stated that the guidance had to be issued within 30 days of the law, which would have been Sunday. And unfortunately, that guidance has still not happened. So we are still going to talk about forgiveness and talk about what we know and what we don't know. And then also wanted to give a little bit of an update on what has transpired in the last week as it pertains to the PPP and other loans and stuff out there. So in the presentation today, there's some information that we're just going to cruise through, but the materials will be available to you to go back and look at later. And the Chamber's had other programs on some of this, and so we didn't want to redo what you've already seen, but wanted to have the information here in one place for you. And so in the materials, there's a really good comparison here between the EIDL loan and the PPP, the Paycheck Protection Program. And again, just to take a look at on your own. Some observations on the EIDL. I know a lot of people have applied for this, and there's a lot of frustration around this loan because they're not getting funded. And originally, when we learned about this loan, we said, and everybody else thought, that there was a $10,000 grant that you would get within 3 days of application. And now that has changed to $1,000 per employee, up to $10,000. They have also added a $25,000 bridge loan. The SBA has started processing these applications that were already in, but they've started reprocessing, but they have not opened it up again for new applications yet. So we're waiting that as well. Some PPP observations, as I stated in the very beginning, guidance has been very slow in coming out. And most of the guidance that we've received lately has been in the form of FAQs, or frequently asked questions. And so Treasury and the SBA post these frequently asked questions. They post a question and then state the answer. And that's the guidance that we've received in the last couple of weeks. And one of these posted last Friday, and it's now being kind of known as FAQ 31. And that is here. And so what this FAQ stated is that if a business is owned by another larger business, and that smaller business might be able to go to the other business and ask for funds, then that should have been taken into account before you requested and applied for the PPP funding. The answer to that question was a little broader than that, and it has a lot of people that have already received the PPP funds a little bit anxious about what, in fact, the SBA may follow up with. And so the answer is a little bit longer than what's on this slide, but here are the key points. Anybody that applied for a PPP loan had to certify that they were making the loan request and it was necessary to support their ongoing business. The answer to the FAQ goes further in to say that the business should have looked to see if they had access to other sources of liquidity. So that could be construed as lines of credit, other bank accounts, or in the case of a company that might be owned by a private equity firm, maybe going to the PE firm and asking for those funds. We don't know any more than what is in this answer, but it is causing some angst in the business world right now of exactly what is meant by this, and hopefully we will get more guidance on this as well. But we wanted to bring this to your attention because it is a pretty significant new event that has happened in the last week. Now we'll move to what we said we were going to talk about today, which is the PPP loan forgiveness. And the basics of this are, everybody knows there are allowable and unallowable expenses and uses of the PPP funds. And that's a super important concept to start with. What can we spend the money on and when can we spend it? And in the beginning, there was some confusion on when does that 8-week period start? Does it start when my application was approved? Does it start when I get the money? And that has been clarified to state the 8-week period of spending those funds starts when you get the money. It is super critical to track as much information around the uses of these funds as you can. If you can put them in a separate bank account and spend the funds for payroll and qualified expenses out of that account, that's probably the best answer. Other ways you can track it, but just the more documentation that you can have regarding this, the better off you will be. And for what are allowable uses, of course, payroll. That's what the intent of the PPP was all along, was basically for businesses, to fund businesses to be able to keep their employees on longer than they would have without these funds. So 75% of the proceeds of the PPP loans have to be used for payroll. And what is payroll? Payroll is salary expense up to an annualized $100,000 salary. So that calculation is as simple as saying $100,000 divided by 52 weeks times 8. And it's a little over $13,000. I mean, yes, total, I think, for that 8-week period. The group health benefits that the employer pays for the employees, retirement benefits, and state and local taxes that the employer pays. Corey's going to talk a little bit about some confusion and still unanswered questions that we have around what these things, the definition of these things specifically as it pertains to the retirement benefits as well. We know there are a lot more questions out there than there are answers on that. The 25%, no more than 25% can be used on these items. And there are also questions around mortgage interest. What is that exactly? And what interest would qualify as mortgage interest? Rent is a pretty basic concept, and you would think utilities is, except in the FAQs, they list some utilities, and then what is the definition of that? So Corey will talk again a little bit more about those. So I'm going to turn it over to Corey now to talk about some of the items that we all want to know the answers to and we still don't have, but we can at least make sophisticated guesses on maybe where we will be going with some of these. Corey?
Thanks, Allison. I'd just like to start. There was a question that had come through that's on my slide, so I'll just start with that. The question was, where are we on the cash or the accrual method? And what I will tell you is that the language in the actual act says incurred and paid during the 8-week period. So what I can tell you in the act and all of the guidance is that for payroll, the costs need to be incurred in that period. And currently right now it's read that it also has to be paid. And so what we're hoping is when the guidance comes out, that paid concept has a little bit of a tail, meaning in days 50 through 56, when you incur that payroll, you are allowed to then pay that post your 56-day window and then also include those costs. Currently, there isn't a firm answer on that, but that's what we are hoping that the guidance will read, and that FAQ will be posted on the Treasury website, and that'll be obviously distributed by every single person on the planet once we find it. The $100,000 limitation is also a pretty good one, and Allison kind of touched on it, where the annualization mechanism has to happen, where the 100K limitation is annualized by weeks. And so this provides a confusion for a lot of payroll people that are paid either monthly or bi-monthly, meaning the guidance that is very specific saying you can pay person 8 out of 52 weeks on 100,000, which I think comes out to like 15,380, versus if you do that on, a 24-month or a monthly payroll, the number is slightly different. So what I would tell everybody now is to stick with the week guidance and work through the payroll calculation and just stay in that limit. And if there's further guidance that allows a different calculation, then you can use it. But as of right now, the calculation on the limit is based on weeks and not either a biweekly or a monthly payroll. The gross versus the net wages is another tricky piece. And it's super confusing because one, when you calculate the size of your loan, you're using the gross wages. So you're sizing your loan and you're making a larger loan based on the gross amount of your wages. And then when you're on the back end, when you're calculating the forgiveness and what is your allowable spend, you don't get to take into account those employer side of your payroll taxes. So that's the concept here is there's a disparity in the amount of sizing that you are making in your loan based on, including the employer taxes on the gross up, but then on the back end, when you're paying it out, you're not being able to take those taxes into account. And honestly, the rationale there is that the government isn't going to forgive you on a loan for taxes that you're paying. I think that's the spirit of it. The mechanics of it works a little crazy, but that's a good piece for you. The related party rent issue has been silent since the guidance came out. The only thing we know is that the rent piece has to be in place by February 15th. So if you have a rental document on tangible and personal property, hopefully you can include it. It obviously includes mortgage rent and interest, but the related party concept is still very vague. Utilities one is probably my favorite so far because every client, whether it's manufacturing and distribution, transportation, hospitality, has a different view of what this is. A lot of people think this could be a car allowance paid to someone. Other people believe that this could be, if you run a pizza store, this could be the transportation that you're delivering your pizzas for. Or if you're in a manufacturing facility, maybe this is the cost of transporting your raw materials into your facility. To be honest, I think all of those are great thoughts, but I have no earthly clue as to how transportation works out to be a utility across all of these different industries. I hope that in the guidance, at some point they issue something. We've asked the SBA, the SBA doesn't have an answer, and we've poked Treasury and they have told us to be patient. But what I tell people is let's calculate your payroll costs, include your interest and your rent, everything that you know that you can. And if that gets you to the answer that you need, that's great. If not, you can have some of these side items that are probably optional and include those when the guidance comes out to kind of get you over the hump. But I wouldn't bank on some of these softer items for the moment. And then the retirement one, I think this is going to drive everyone crazy. It goes back to the cash versus the accrual method. And what we do firmly believe is that if in that 56-day window, 8 weeks, you have a retirement obligation that is incurred, which could be a match, then you pay it, that's going to be 100% solid. A lot of people are asking about a 2019 match that has been paid in 2020. It's not clear. That is clearly not incurred. And historically, if it's made during that period, you might have an argument. But until the guidance comes out that clearly defines where the shift in the window fits in for retirement, I would bank on including anything that is incurred, a match, anything like that, a profit sharing plan, incurred in those 8 weeks, 8 weeks and 56 days, and then paid as well. Anything outside of that strict kind of window or box, I would keep in that side slot. So if you need it, you can use it at a later time. And then obviously prepayment falls in that same kind of bucket. What we're telling people is credit card charges are generally, from an accounting perspective, when you charge it, those are incurred and paid. So the payments of those are okay, but prepayment maybe on, let's call it a cell phone plan where you're prepaying for a month, that's gonna be a tough one. Or maybe you're gonna prepay utilities. Those aren't your normal type of transactions. It's probably not a good idea to try to include them. But if we get further guidance that says you're more than welcome to, that would be great. And then the period is probably just as fuzzy as everything else. What we do know is that the day you receive the loans, that is day 1, and day 56 is the day that it apparently stops. It's not clear about where 630 falls into play. What we believe is that 630 is a soft cutoff for people that have received loans and are trying to keep people on payroll. It's very, 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 very limited, the language in the Act, and there's no FAQs that currently talk about keeping people on or what the 630 date really means. I think it was just a calendar that they were trying to put together for all of this. And I do hope that we get some guidance on it. The documentation piece is going to be pretty interesting, right? Payroll reports from your payroll company, 941s based on your quarterly tax filings, those are going to be great. Any type of invoice that you get, especially for related party rent, that's going to be an excellent one. Any type of mortgage, debt, lease agreements that were in place obviously before that date are going to be key, whether they're arm's length, third party type, or if they're intercompany as well. Obviously, if you have the canceled checks that show your payroll runs, that's going to be super helpful for the bank and then the SBA's their look back through. And then, as Allison talked about, a lot of people are using a separate bank account. It's a great practice, and from that perspective, you can run a bank statement, and then you'll have the checks and all of the withdrawals right there. And through all of the documentation, what I will say is have a discussion, a healthy discussion now and in the next few weeks with your bank. Because how it's going to work is once the 8-week period runs out, what'll happen is you'll have 60 days to have a discussion with the bank and submit them everything that they're asking for. And in that 60-day window, they'll have to make a determination and present that to the SBA for forgiveness. And so your best friend in this is going to be the bank, your personal banker, your community banker, or if you've got JP Morgan, the banker that you're working with, or if you've got Wells Fargo, the same thing. They're going to have some sort of system in place where they're going to verify and help you through this piece. And that's going to be the most critical piece. So let's kind of talk about the basics and what we're talking about here. The forgiveness piece is going to fall into some buckets, and we'll walk through a couple of examples. You have some options. You can get 100% forgiveness. You can get a partial one. And unfortunately, there are situations where you could get none. Everything that we have right now is based on that 56-day or 8-week window from the day you receive the loans from the bank. And I had talked about there's going to be a forgiveness application that the bank and you will have to walk through, and they will verify it based on the documents that you provided. And at some point in the next 30 days, the banks will receive an interim rule from the SBA and Treasury guiding them on what they're allowed to receive, what they should receive, how they should document. So have that discussion now with the bank, and they'll just say, hey, hold tight, we'll have a great discussion when it's time, but keep the documentation handy so that when you do have it, you're ready to go. So allowable and forgivable costs has been unclear to a lot of people. So I'll go through these rather quickly, but you can read the slides. There's a discrepancy between what you're sizing your loan for and what you're spending the loan for, right? And you can kind of look at this here left to right and see. The biggest problem on the forgiveness side is one, if you reduce your payroll for an employee by more than 25%, that's going to be a ding on the forgiveness calculation. The second one is going to be a full-time equivalent change. We'll go through how that works, but if you reduce your full-time equivalents from a comparable period, you have less employees on payroll now than you did at 2 other points in time, there's going to be a hit to the forgiveness. And so the items that we're going to walk through, and we'll do calculations that are kind of quick and you guys can kind of look through them. One, did we spend enough money on the allowable cost? That's one of the thresholds. Second one that I talked about is going to be, did you maintain enough full-time employees? That includes the people that you brought back on, whether from furlough or unemployment, by June 30th. And did you then maintain that 75% wage for all of these employees, not reducing their wages by 25%? And the excluding high earners is if somebody makes over 100, your CFO makes 200, you can drop them from 200 down to 100, and there's no change to any items that we're talking about because the cap for that person is already at 100,000. And then was enough spending did we spend enough spending? 25% or less is on non-payroll, so you have to get to 75, 76, 77, 78% on payroll for the items that we're going to talk through. So the incurred and paid test here is fairly simple, is did we spend enough money? We got a $200,000 loan, and we only spent 160. So the amount that is going to be reduced, that is available to be forgiven, would then be the amount that we spend. So in this calculation, your loan, the amount that is allowable to be forgiven, would be 160, not the 200 that you started with. I think that one's pretty clear. The rest of these are going to get a little bit more fun. So did we maintain enough employees, full-time equivalents, currently during the 8-week spend period versus the 2 comparable periods? So in this example, we have the 60 is going to be our comparable period, and our covered period are 8 weeks, 56 days. In our comparable period, the number we need to achieve to is going to be 70. So we are short 14.3%. So in this example, we are going to lose out of that number, the 14% of our spend, whether it's on payroll costs and the proceeds less payroll costs. So we are going to lose out on approximately $23,000 by not having enough employees. And so this one, I think, is super important for people right now, as you're getting the loan proceeds, looking at the covered period, the 8 weeks, how many employees can we get to? Some people won't come back to work. And what is our baseline? And so calculating the baseline of February 15th to June 30th, or your average of January, February of 2020. Whichever is lower, that's your baseline. So start looking at that immediately, and you can start figuring, okay, how much of this 100,000, 200,000, 50,000 can we actually get forgiven, no matter how much we spend?
And Corey, on the FTEs, I think there might be some confusion also, is that when people were applying for the loan, it was a head count that they had to put on the application, and that's different from an FTE. And we've gotten a little bit of guidance on FTEs, but still not complete. And so just to clarify for what we believe today with what we have, that for this calculation, an FTE is defined as all of your full-time employees count as one. And then for your part-time employees, you add up the hours that your part-time employees worked in that 8-week period divided by 30. The SBA considers a 30-hour week full-time. And so you take your total part-time hours divided by 30, and that is your FTEs for your part-time employees. And also to clarify on the benchmark period, that February 15th to June 30th date is 2019, or the January, February 20 that you're looking to compare and using the lesser of those two.
Yeah, that's great, Allison. I think the FTE equivalent is a key component of this. A lot of people don't have a lot of experience with it, and most of us didn't before this anyway, unless you worked with the SBA.
Right.
So then the wage level test, as I explained, is fairly simple. This is a good one just to keep in mind, is if you have employees making less than 100, you have to keep them at a minimum of 75% during this period. And so if you do not, then you are going to have a haircut to the amount that can be forgiven. So if you have an employee that makes 110,000 and you reduce them to 90, that is a 10% reduction because it starts at the 100. And like I said in the example before, if you have an employee that makes 200 and you cut them down to 100, for this calculation, it is a 0% change. So the ceiling here is 100, and until you drop below that ceiling, there is no calculation.
And Corey, do we know that, say we reduce somebody by 27%, is it an all or none reduction, or do we just have to reduce our forgiveness by that 2%?
That is an awesome, excellent question. I wish I knew. I would hope that it's the 2% piece, but some of the guidance has been all or nothing. A lot of the stuff is the sliding scale, the 2% example, but until the banks get the detailed calc that's been audited by the SBA, it's going to be a tough sell. Guidance, what I tell people is try to figure out what is going to work for you guys. And if you can get to that 75%, then you don't even have to worry about it. If you can't get to that 75%, be cognizant of when you're not going to be at that 75%, who it is and how much you're leaving on the table. because what we found is a lot of times with the size of the loan, if you're gonna have allowable costs that are gonna be short, those are the places that you'd like to plug in the 2% just to get to 75. If you can't get to the 75, you can't get there. That's just a function of how the projection works.
Great.
So then the fourth question is did we spend enough on the payroll piece? And so you can walk through this, right? It's gonna be much easier when you can pause what we're talking through and kind of read through it. But you know, your payroll costs are still gonna be the 100,000. Reductions that we took for the 100,000 and then the drop are included above to get you to the starting point where you're at, which is the 75,714. So 75% of that needs to have been spent in the payroll context. And so the limit that you're going to get for your non-payroll costs based on your loan is going to be the 25,000. So that's going to be your interest, and that's going to be your rent. That's going to be your transportation, your utilities, and the utilities we think is pretty broad because that's defined, you know, in a lot of other language that we use around this. And the utilities, your water, your cable, your telecom, meaning your hardline phones and your data going into the facility. It's very unclear whether or not a cellular package can be included in the utilities piece. And then this details out the amount that your reduction is going to be. It's going to be the 26,190. So those are kind of the tests, and that's the. Do we know the order of these tests? Unfortunately, the answer is no. I wish we did, but we don't. And so, as Allison and I talked through, there's whispers, and we say whispers because there's nothing in any of the language that says if you drop to 74%, you're out the door. We've just heard that from the SBA that the spirit of this is what they're going for, and for people that are non-compliant, kind of like Rule 31, they kind of want to throw them out the door. But that's why we're saying, hey, let's try to make it to 75% as best we can, and if not, just be aware that this could be a zero. We're hopeful on the accrual versus cash, and you can kind of rewind and listen to how we talk through that piece, because I think that's key to know is, okay, in these 56 days, what was truly incurred, and then when did we pay it? And most of the time, you're going to get to approximately the same answer unless your wages were a little cyclical. The FTE calculations, for all of the guidance that we have from the SBA, everything in there relays and sticks to the 30 hours. We believe that, is it firm because it's written in anything that the SBA or the Treasury is putting out? No, but every other type of loan document that the SBA has worked through is a 30-hour commitment. The assessment of the frequency of the pay periods is another tricky one. Stick with the weeks that we talked about. Keep your pay periods as they are. Don't change your pay periods for this. Your monthly, your bi-monthly, your bi-weekly. Keep your pay periods, and then just calculate the wages as they're incurred in the 56 days. And if most of your people are paid without a commission and they're steady, the answer is going to work out in your favor. If they're not, just be prepared. You're going to have to jump through some more hoops, and then hopefully we'll get some guidance on the tail piece that will definitely help people out. So the next slide is just going to talk through about some questions that we're going to have on forgiveness. And these are great questions. If you don't rehire, what do you do? What's going to happen is your FTE number is going to be lower, and you're just going to have to deal with the amount of excluded costs that are going to be able to be. A lot of people are trying to rehire and they can't. It's an unfortunate consequence, but I will tell you, make sure you talk through it with on the HR side about how you're extending offers to your employees, because they're on the unemployment side, you know, there's certifications that the employees have to make as well about being willing and able to work. So make sure that you're making these offers back to your employees and get them back to work as best. But it's obviously a choice, and it's up to you whether or not you want to rehire them. If someone leaves during the 8-week period, this is a great one. Unfortunately, for this, you can kind of extend this on. A lot of people say, well, I had 10 people retire in my period last year and I haven't replaced them. Unfortunately, there's no wiggle room in the comparable periods now for this. And so what we believe the 8-week period is, it's going to be an average FTE. So if you get 7 weeks out of them, I think that's great. But just be cognizant of those numbers. And had people retire and maybe their workload was absorbed somewhere else, it's going to surface when you're doing these FTE calculations. The new employees, I think those are amazing. Keep them on the payroll, and hopefully you're in a situation where at this point somehow you can bring in maybe a few more full-time employees to get them off unemployment. I think that's a great question. It's a benefit to have new employees. There's no penalty, there's no disincentive. Obviously you have to pay them, but there's no disincentive at all whatsoever. We put some resources. The Treasury link is probably my favorite, but it's also pretty scary because it just gets updated every random few days. And here at CLA, when it gets updated, your inbox gets flooded with every person, every client, everybody that saw it. So I don't have to monitor it. I know that 100,000 people out there are, but check that website. It has all the FAQs. It's actually really good. It doesn't have a lag or a server issue. So you can get on that one whenever you want. The SBA has some great links as well. They have a lot more options than the Treasury. The Treasury is just focused on policy. On CLA's website, there's a lot of stuff out there as well. It's broken up into, I would say, 3 pieces. One piece is you can submit a request, you can send to our team, and it gets answered real time by somebody like me or somebody else on the COVID team. Second piece is all of the live streams that are listed here. There's 2 of them a week on Tuesday and Thursday, somewhere between 2 and 4 p.m. The great part about the live stream is there's a group of moderators that answer questions as they're coming in. And so we're on YouTube responding to all the questions. And then there's a 30-minute segment that's live that takes questions from the users and then questions obviously that are set up, and they answer them as well. And those get pretty good traffic. So if you have a specific question that you think is easy, log into the live stream, ask the question, it'll get answered. And if you need to go further, you can submit a request through our Power app. And then the third piece on there is it has a lot of stuff that we put out in content that every other CPA firm has put out as well. We like it because we wrote it. Other people might not like it, but it'll at least give you some other links to find stuff. And it's broken out by what segment of a business. It's broken out by accounting, by tax, by disaster relief. So go check that out. And then obviously the U.S. Chamber of Commerce has all of those links and more. So if there isn't enough content out there, especially when you're working from home, here are 4 more places for you to check.
So Chris, are there any questions that you want to pose to us, or just wrap it up?
Well, first I want to say that that's not confusing at all.
No.
I mean, I don't see what the big deal is.
Exactly.
I'm glad we have people like you two that know what this is, so we can get questions answered. You know, I'll have you guys look at the questions on here as well. And Allyson, if you can, you know, take your screen off there. But I think that we've answered all of the questions that we've gotten here. Corey, I don't know if you're looking at these, but I think that you've hit on everything that, you know, through your presentation that we've been asked here. Is that accurate?
Yeah, no, I was kind of monitoring through there and made sure that we have. I mean, there's one last question asking if the PowerPoint's going to be available, but I think 100% it is.
Yeah, you know, we'll talk with our team about that. Obviously, like I've said before, these are being recorded, and so this video will live on our website. This video will live on Facebook, so you can certainly go back and look at that. But I'm certain that whoever would like this presentation, that we can get you connected with CLA, or we can get it over to you. So just email us directly and ask us for that, and we'll make that connection. So fantastic. Well, thank you very much for that. A lot of information. My goodness, that's I do not envy you.
Thanks so much, Chris, for the opportunity.
Absolutely, absolutely. So before we sign off here, just wanted to let everybody know we'll be back again tomorrow. We've got some HR compliance discussions that are going to be happening tomorrow. So please tune back in at 2 o'clock for that. And then I also want to let everybody know near South Side, so Leon Bridges is going to be hosting a live online event tomorrow, concert tomorrow evening. And so you can buy tickets to that, and all the proceeds for that will be going to the Near South Side Cares Fund that they've put together. So if you have any questions on that, get on the Near South Side Facebook page. All the information is there, or you can reach out to us and we can give you the information as well. So thank you again for tuning in. Thank you, Allison. Thank you, Corey, for coming on, and everyone have a great rest of the day.
Thank you.
Thank you. Thanks, Chris. Have a great one.